Welcome to the FinLink Fincast, where we talk about everything wealth management, especially as it pertains to M&A. Here is your host, Xander Heinen.
Welcome to the FinLink Fincast, where we talk with the experts about everything wealth management, CPA, and insurance, especially as it pertains to M&A. Today, we have a special guest from Advisor Financing LLC, Greg Prokott. Welcome, Greg.
Thank you, Xander.
I just wanted to say before we get started, as a former lender in the space, we've had a couple podcasts now with our lending partners, and I wanted to emphasize something to our listeners about the lending space, especially in our industry. Every lender is very much different, from rates to prepayment penalties to amortization periods to fees and to valuation mandates. We're all different in that space. So I guess, what I was really excited to have you on and discuss is why you guys are different. I know in our initial call, there are some real things that popped out for financial advisor financing that make you especially different. So I guess let's start with, let's get a little bio of you and how you started in the industry, and then we can move on to the kind of the evolution of advisor practice acquisition financing.
Yeah, happy to, Xander. So, excuse me. I've got 25 plus years in financial services. 20 of that was as a wholesaler. So I speak fluent financial advisor. And I know that advisors measure us wholesalers in dog years. So I did that for about 140 years. And that was quite enough of that. So it was time to find another project. But working with advisors is in my DNA. And so I wanted to find something that provided a service in the space, and was fortunate to find this area of lending to advisors. There's clearly a strong need. Average age of a financial advisor is 58 years old. Average age of a founder is 67. And so we've been able to provide a very well-needed service in the space. So we've been having a very good time doing that. I've been doing that for about 6 years now, and it's a relatively new space. So 6 years is an eternity.
Yeah, especially in wholesaler years.
Right.
And I also started in the wholesaling space, which is one of those niche jobs you don't learn about until after college. But yeah, I definitely understand how you speak the language, and it's a great place, to transition over to your current position. So give me a little history on advisor financing. I know you guys are a lender that is started by lenders. So that really caught my ear when we first discussed it. I would love to hear just the history of advisor financing.
Yeah, happy to. So the genesis of our firm is we were started by a gentleman by the name of Troy Weingartner, who happens to be a financial advisor. So we are a firm that provides services to financial advisors, built by financial advisors. And about 8 years ago, Troy was going to the marketplace trying to find capital to buy out a portion of his own senior partner's practice, found it to be an exceptionally frustrating situation. And so he thought there's got to be a better way to do it. So he created advisor financing.
So tell me a little bit about that. I think there's a lot of folks who think, a bank is a bank, a loan is a loan, whether it be for your house or for your practice, or to buy a practice. Why would an advisor not just go directly to their bank for financing? How do you guys make it, more streamlined? How is it more efficient and easier to get a loan through you guys?
Yeah, that's a great question. I get that question fairly frequently. Why don't I just go direct to the bank? And you absolutely can do that, but this does not fit in the historic banking model. Unfortunately, there's no building, there's no equipment, there's no airplane to put up as collateral. And so as an advisor, you could go out to 6 different banks and see if they'll take care of you. And 4 of them would look at you like you got 3 eyeballs. One would try to jam you into an SBA loan. And the last one would say, yeah, we could do that. And then they'd take it back to their committee. And some old codger in the corner with mustard stains on his tie would say, oh, we've never done one of those before. And he'd come back to you in 3 months and say, oh, I guess we can't do it after all. So we've done the legwork for you, have gone out, found and cultivated and trained various banking partners on why this is a good space. And they know us and they love us because we bring them good deals like this. But in the end, another differentiating factor is those partnerships with the banks are exceptionally important to us. But in the end, we are the advocate for the financial advisor. It's my job to find them the best deal that's available in the marketplace.
Yeah, and you guys have a pretty broad stable of banking partners. How many partners do you guys typically have?
Yeah, I'd say it's probably 8 or 10. And
Right.
so people say, well, is it 8 or is it 10? Well, if I'm working closely with 4, we've got 4 more that are kind of on the second tier, and then there's 2 more that we're developing at any given time. So I've been doing this about 6 years, and at that point, we had 1 local partner. I happen to be in the Twin Cities area, and we had
Yeah.
1 national partner, which they both served us very well over the years, but on occasion, whether there's a COVID moratorium or whatever other reason they decide to not pursue a deal, that can be a little frustrating. So having options is certainly in our best interest and the best interest of our advisor clients.
Tell me a little bit about the rate environment right now. What you guys are offering. I know that Advisor Financing provides, very good terms and rates. I don't even know what the rates are currently. Forgive me.
Sure.
We used to at Live Oak, we used to peg to Wall Street Journal Prime. Would love to hear, what you guys are pricing to, what your current rates look like. And then, what the fees look like, what, prepayment penalties look like, what typically, are you guys seeing in the rate environment and, pricing?
Okay, yeah, happy to address rates, and I'll back up just a touch. Our claim is that we're the low-cost provider of capital to financial advisors engaging in practice acquisitions, internal
Okay.
transitions, and refinancings of that debt. And the reason we're able to make that, as I kind of mentioned to you previously, Troy, our founder, has a day job. He's a financial advisor, so his
Yeah.
office is paid for. I work from the old wholesaling model. You're looking at my office. Uh, we were virtual before virtual was in vogue, and so my other colleagues also work out of our homes. And so our overhead is virtually nil. And so when I give you these rates, and we anticipate we'll be 50 to 200 basis points lower than anybody else in the space. And so what we're seeing lately, you go back 2, 3 years ago with COVID, boy, rates were incredible. We were doing rates below 5% fixed.
Yeah.
And so very attractive to the advisors. As we all know, rates have taken a bump up. And I think on the high side, we probably hit the high 7s, 7.5, 7.75, give or take. But I know that a lot of the other entities in the space were talking double digits. Another element that works, I think merits discussion is the BDs that offer their own internal financing. And it makes all the sense in the world for them to do that. It creates a turnkey solution for the advisors. They want to make it easier for them to acquire, to transition internally, but they're not banks. And so
Right.
their incentive is not to give you the best rate that's out there. They make it easy. You have the feeds for all of your financials and so forth. They pull the payment rate out. But if you're willing to do any level of work whatsoever, we can literally save you tens of thousands, hundreds of thousands, potentially millions of dollars for your loan. And so I say right now you're asking for a snapshot in time. Obviously, this is effective for the next 24 hours, 24 minutes, however long you want to
This
stay.
is May 15th, 2025. So
Right, exactly. Right now, we're probably in the range of 6.75 to 7.25 fixed. We're doing 10-year amortization loans typically, and we lock the rate for 5, 7, or 10, depending on what the preference of the advisor is, and also which bank we align you with. And, we make those decisions around talking to the advisor and find out optimally what they're trying to accomplish. So it's a 10-year AM, locker rate for 6.75, give or take. I think you put that into your assumptions, you'll be pretty accurate.
yeah. Let's go back to something you said earlier that piqued my interest. You know, the BDs are providing financing now. Um, you know, they're not bankers. They're not lending institutions typically. Um, you know, I not to speak ill of any BD out there, but I think there's also an incentive for them to use lending as a retention tool.
Mhm.
Have you seen, you know, can you speak on that? Have you seen any kind of crafty ways that they're using their internal financing to keep their advisors where they are?
Yeah, there is a BD that should remain nameless that is using it as a brilliant retention tool. I state that we're the low cost provider. I'd say they'd be the exception. But that said, you're coming in with some pretty heavy golden handcuffs when you sign into that agreement. The loan is 10 years, so you're locked in for that 10-year period, but there's an additional 2-year non-compete in addition to
Oh,
that. And say you get a 10-year loan, you pay it off in 6 years, and 2 years later, you decide for whatever reason to make a move, retroactively to day one, that rate is increased by 12%.
yeah, yeah.
And do immediately. And
Yeah, and that's why, you know, I just, you know, when I have these conversations about lending, I just want to make it very clear that all lenders are different. Always read the terms of the loan. No any clawbacks, no any retention periods, no any non-competes, etc. Really
Mhm.
do your due diligence when you're getting financing. Just because there's so many different variables, like I said in the beginning of the podcast.
Yeah, I mean, it's an exceptional BD, and if there is no chance that you're going to make a move in as advisor in the future, it's a great program. But 12 years is a long time, and things change.
Can we discuss a little bit of, you know, what the appetite for financing is with you guys right now? What's the pipeline looking like? You know, how's activity on your end? What are your thoughts on the future, near-term future of, you know, just M&A activity in the space?
Yeah, boy, I can answer that on a number of different levels. If you're talking broad-based across the industry, you know, with average, we talked briefly about the demographics of the space, average
Yes.
age 58. I mean, obviously, there's a lot of folks need to be transitioned. I don't know offhand what the statistics are as far as how many advisors have a transition plan in place, but I can vouch that it is less than half.
Yeah.
And then there's the rolling 5-year plan that happens on occasion where, yeah, I think I'll address that in 5 years. And 5 years later, yeah, I think I'll address that in 5 years. And 5 years later, then they have to move into a panic scenario when they're forced to make a move. But there's a huge appetite within the space, first of all. I think we are becoming more well known within the space also. And so this may or may not be reflective of the space in general, but we managed to triple our business last year. And
Wow.
we have already done the amount that we have done in all of 2024 year to date. So I think it's a combination of a rising tide with getting our name out there a little bit more, but we're doing quite well. But, you know, how's the pipeline look and what does capacity look like? As we've added banks, that enhances our capacity and our ability to fulfill as many loans as come our way. So it's been a great timing in adding capacity and a lot coming in our direction.
Nice. Well, congrats on that.
Thank you.
I guess that brings me into, you know, what's the typical time? I know that was you know, everybody thinks they have enough time to get a
Right.
deal done, and financing is always a crunch. What's the typical, you know, start to finish time you guys see in a loan? And I'll put a caveat in that, um, you know, as a former lender, lenders need their documents complete,
Hmm.
signed, and, you know, packaged, and sent to you, and that's when the lending process really starts. So, um, you know, what would your typical, you know, in terms of days period be to close a loan?
Yeah, that's a great point. The first thing I always say is the clock starts when we have a completed file,
I
because as you might
think every
imagine,
bank does that.
yeah. And so As you might imagine, some advisors turn it around in 2 days and some take 3 months and then wonder why the loan wasn't done yesterday.
100% of the time I've heard that.
Yep.
Yep.
You feel me on that one, I'm sure.
Yeah.
So generally speaking, it takes a couple of weeks to get the file completed, and we have a document checklist that has all the things that an advisor would expect. 3-year tax returns on the individual and the company, P&Ls, balance sheets, so on and so forth. But once we have that completed, we'll scrub it somewhat, and then we'll open it up to one of our banking partners. And this kind of addresses another element of it. Some might think that we would open it up to the entire 8 or 10 partners that we have. And in my view, that's not being a very good partner to them. Because it's, well, Joe, you did all that work, you scrubbed this file, you came to us with a proposal, and you're just not good enough. You're 10 basis points too high, and we're giving this to somebody else.
Yeah.
And, that's creating a lot of job for them. And so that said, we understand the capabilities of all of our partners, who's the lowest at any given time. There's geographic reasons to go to particular banks. There's capabilities, there's certain subtleties, and so we'll generally pick one of our banking partners. And 95% of the time that fits. If it doesn't, we can pivot very quickly. So that just an off element to your question. So the question was really about timeline. So a couple of weeks, we open it up to one banking partner. We will typically then have a Zoom or a phone call with the advisor in the bank so they can get to know each other. As you might imagine, a lot of the answers are in that file, but that file creates more questions.
Yes, indeed.
Having those face-to-face meetings is very valuable. They get comfortable. The advisor gets comfortable with the bank. And so that leads into after that conversation, we hope to have a term sheet inside of a week. I'll review it with the bank, make sure I'm okay with it. I'll then bring it to the advisor client, potentially have some tweaks, or upon their acceptance. You'd mentioned fees also. We get paid 2 different ways. There's a small term sheet fee upon the acceptance by the advisor, and that's generally in the range of $1,000 to $3,000 or $5,000, depending on the size of the loan. But that's likely their only out-of-pocket expenditure. And if you're talking an average loan in the 2 to 3 million range, that's barely 10 basis points. That's just a skin in the game, make sure they're serious. And so upon their acceptance, we're probably talking 6 to 8 weeks to get it to closure. And then that leads into the second element of how we get paid is there's a 2% origination fee, but that can be rolled into the loan, and that is due at closing.
Okay. And does that cover like UCC searches? And I don't know if you guys need valuations for all your banking partners. Are those added fees, or how does that look?
Yeah, some mandate valuations, others don't. Some sometimes ask for valuations. As you might imagine, given the space that we're in, we've got a good half a dozen firms that we can bring the advisor to get a valuation done.
Yeah.
And we get discounts because we bring them volume. As far as the fees, some of the banks will have additional closing fees, UCC filings, much to what you're addressing, but that's generally below $1,000. And we will only go to a bank that has additional costs if net their rates are the lowest. And so,
Gotcha.
again, our objective is to get you the best cost. And so if that involves additional fees, the advisor can be comfortable that at the end of the day, they're writing the lowest check that they can.
That means a lot to the advisor going through all this.
Right.
So I guess to kind of end the combo, after talking about how non-typical loans look, what are the typical loans that you guys are providing right now? This is obviously very generic, but what's
Sure.
the typical loan size? You mentioned rate earlier. Just love to hear what that might look like. If you have one on your desk right now, what would that look like?
Yeah, they're all different, but they do rhyme. So there are plenty of similarities. Virtually all 10-year amortization. We've seen some demand for longer amortizations in the marketplace. and have had the discussion with our banks around that. I've heard of some entities offering 15-year ammos. The challenge there is that, well, why do they want that? Because cash flow is tight. Well, then maybe you don't qualify.
Yeah, yeah. And those are usually, 10-year balloon, and then it's a 10-year with a 15-year AM, right?
Yeah, exactly. So that said, what is a typical loan? So on average, I'd say 2 years ago, our average is probably 1.5 million. But with the increase in businesses come increased sizing. And so we're probably more like 2, 3 million. We have acquisitions where it's a big fish eats small fish. The guy running 500 million is buying a $50 million chunk. We have had small fish eating big fish. Sometimes those are transition plans where the challenge with next gen is the younger generation hasn't had the glide path to accumulate net worth.
Yep.
And they can't afford to buy, you got a $300 million AUM, that's a $10 million practice, give or take. So you
Yeah,
can't.
that was possible. That was possible 10 years ago when multiples were half what they are today.
Exactly.
Right.
But now we're talking, nearly 3x on recurring revenue on an average, and it varies around that, of course. But you'll have potentially 3 junior partners buying a senior partner out, and taking some of the burden off each other and transitioning effectively because they're the ones been working with the clients for the last 5, 10, 15 years. Uh, we do a fair amount of refinancings also. Not as much as we were when rates were coming down, but we still find a fair number of scenarios where maybe they're doing BD refinance where they're in double digits and they can take a significant burden off their cash flow. Uh, what else? I think that's a lot of, there's exceptions. We have done a 12-year amortization, and so, we found reasoning and comfort with the bank that they'd be willing to do that. Uh, can't think of many one-offs other than that, but in 5 minutes after we're off the call, I'll think of 6 more.
Of course, of course. And that's banking and lending for you these days.
Right.
Well, I really appreciate you coming on today. And then for our listeners, you can reach out to Advisor Financing on our resource page. There's a contact us button. Just to let you know, Greg, we're going to be adding a lot of education going forward. So we'll be relying on some of your resources that we'll have on our landing pages, and we'll have more podcasts and definitely market updates with you guys as we go forward. So really looking forward to building out the network and having you as a resource partner. But I really appreciate your time today, and thanks so much for coming on the FinCast.
Wonderful. Thank you so much for the invitation, Xander. Website, obviously you can access us through your site, but our site is advisorfinancingllc.com.
Yep, go check it out, guys. All right. Well, thanks so much, and you have a great day, Greg.
Thank you, sir.
Bye-bye.